What is alpha and beta in stocks? Coming to terms with a lot of the different terms used when you first begin your journey in trading stocks is arguably one of the most complex parts of starting out. This is why we aim to keep you updated and in the know with all of the information you need to know throughout every step of your journey in trading stocks. Two terms you'll hear mentioned frequently are alpha and beta, and while you might know what they mean outside of the context of stocks, you still need to know exactly what sort of meaning they have in this context. So if you're new to stocks and are unsure about what these two terms mean, or just want to brush up on your knowledge, then read through our guide to find out everyone you need to know. Putting it simply, alpha and beta are two different measures that are involved with the same equation that has been derived from linear regression. This equation is used to help explain how different investment funds and stocks are performing. The excess return on an investment, once you've adjusted it for the volatility, that is related to the market and the often random fluctuations, is known as the alpha. Overall, both alpha and beta are forms of measures which can be used to predict and compare returns. If you're not too familiar with algebra, then looking at this equation might confuse you even further. However, if you feel comfortable with algebra, then have a look at this equation, as this is the basic model. This all might seem too confusing, but don't worry, we're going to explain it more in further detail down below. So if you're not particularly adept at understanding algebra, then we'll help make it easier to understand. It's surprisingly much easier to discuss beta first before we begin to look at alpha. Beta is seen as a form of measurement of the volatility that is relative to a benchmark. It's used in order to measure the systematic risk that a portfolio or security may have when compared to something like an S&P 500 index. Generally, most growth stocks will tend to have a beta that is over 1. In fact, it's usually much higher than this. A treasury bill, T-bill, would have a beta that is near to 0 as its price moves very little in comparison to the rest of the market. Beta is also a multiplicative factor. For example, a 2x leverage S&P 500 ETF will have a beta extremely close to 2, which is relative to the S&P 500 as a result of its design. Therefore, it will go up or down by twice as much as the index in any given period of time. Alternatively, if the beta is 2, it will move in the opposite direction to that of the index by a factor of 2. Investments that feature negative betas tend to hold treasury bonds or inverse ETFs. Alpha. If the alpha is greater than 0, then the investment in that asset has outperformed once it has been adjusted for volatility. For example, if investing in small cap value stocks, these stocks tend to have higher returns than the S&P 500, which means that the correct index to be used would be a small cap value index, which would provide a much better benchmark than the S&P 500 would. They're incredibly important, so you should become comfortable knowing what they mean. But you should also ensure that you learn exactly how they are calculated, as it's a difficult process that can be easy to get confused on. So just be sure that you learn how to do it properly. Despite knowing so much about the system and the different ways you can use it to your benefit, I still found the transition rather difficult.